One of the counterintuitive rules with partnership taxation is that the partner must decrease her outside basis for non-deductible items that are not properly chargeable to a capital account. This seems a bit counterintuitive, but the reason why the rule exists is that it preserves the pass-through nature of the partnership, and it also exists to prevent a double benefit. So this is just sort of the reasoning for it. So no double benefit, no double tax benefit, let's say. The idea being that if the partnership has an outlay that is a non-deductible item to the partner, or is even non-deductible to the partner herself, that would still, it being an outlay of the partnership, decrease the outside basis of the partner. And not every outlay is, of course, a deductible item or non-deductible item. Some items are capitalized, meaning that they would be charged to a capital account. Let's say, for example, if the partnership were to buy a building, which would probably be a Section 1231 asset. Okay, well that's not what we're talking about here. We're not talking about those sorts of outlays because those are capitalized. That would not decrease the partner's outside basis. In this instance, it would simply be the partnership would have purchased a building and would have exchanged cash for the building. But the idea of decreasing outside basis for non-deductible items is to prevent a double benefit. Once for the partner taking this deduction on the partner's tax return, and then again realizing a loss or perhaps less of a gain on the sale of the partnership interest, as an example. So we'll go through an example here with a partnership involving partner A. There are other partners out there, but we're not concerned with them. And this partnership allocated to A $20 Section 170 deduction. The Section 170 deduction, as you'll recall, would be a deduction for a charitable contribution. And it just so happens that this is a non-deductible item. And we can find that it's a non-deductible item in Code Section 703A 703A2C, which essentially says that in computing partnership income, the partnership is not allowed a charitable contribution. So no charitable contribution deduction. Nevertheless, this amount passes through over to A. So the rule with adjusting outside basis is that these items would decrease A's outside basis. So A has a beginning outside basis at the very start of 100. This amount is then decreased by 20, which is the amount of the Section 170 deduction, which, although disallowed to the partnership, passes through to the partner and is required under this rule, 705A2B, it must reduce A's outside basis. So A's ending outside basis is 80. And we'll see that A only gets to take this deduction once on a hypothetical sale, we'll say, of A's partnership interest. So in this case, let's just say, hypothetically, someone is willing to pay $80. I picked that number just to make the computations easy. It could be more, it could be less, but for this, we just want to have the partner selling the partnership interest for $80, which just so happens to be A's outside basis. So now we have the adjusted basis, where you could write the outside basis here of 80, and the amount realized being what someone else pays for it, less the adjusted basis gives us a gain. And in this case, the gain is going to be 0. So we can see that A got to take this, or got the benefit of this Section 170 deduction just one time, namely on the tax return. And so this 20 would have gone from the partnership via the form K1, and that A would then put that on its form 1040 and would get to use $20 to offset income that may be coming from other sources. It's not like this partnership is the only thing that A might be doing. A might have wage income, A might have other businesses, and so all of this would pass through to A. So let's show an example of what would happen if this rule were not in place. And let's demonstrate the double benefit. So I'm going to do this in red because this is wrong. So we're going to do a hypothetical sale of the partnership interest, just as we did over here. And we're going to make the amount realized the exact same because this is just so happens to be the market value that somebody else is willing to pay for it. And here's where things go awry, is because the adjusted basis, if the rule under 705A2B were not in place, the adjusted basis would be 100. And A would have a loss in this case of $20. So on the sale of this partnership interest, A would get to realize and recognize a loss of $20. So not only did A get the benefit from the current deduction, so we'll say from the deduction perhaps earlier in the year, or maybe from a prior year, from the Section 170 deduction, but A also got a loss deduction. And this is the double benefit that the code wants to get rid of. So no double benefit. And this is an illustration of the logic for decreasing outside basis for non-deductible items not properly chargeable to a capital account.